Let's start with the basics. Silver has been an essential component in solar panel manufacturing for decades. Every photovoltaic cell contains tiny silver electrodes that collect and transport the electrical current generated when sunlight hits the panel. These silver paste electrodes are crucial because silver possesses the highest electrical conductivity of any metal on Earth. For years, this seemed non-negotiable. If you wanted efficient solar panels, you needed silver. Period. But here's where things get interesting. Silver currently trades around $26 to $28 per ounce, with significant volatility depending on market conditions. Throughout recent years, we've seen silver swing from lows near $20 to spikes above $30. This price volatility, combined with the sheer volume of silver needed for the global solar boom, has created an urgent problem for solar manufacturers. They're burning through roughly 100 million ounces of silver annually just for solar panel production. That's about 12% of total global silver demand, making solar the second largest industrial use of silver after electronics. Do the math with me for a moment. At current prices, that's roughly $2.6 to $2.8 billion worth of silver consumed by the solar industry every single year. For manufacturers operating on razor-thin margins in an increasingly competitive global market, that's an enormous cost that directly impacts their bottom line and their ability to compete with fossil fuels on price. Now here comes copper into the picture. Copper trades at approximately $4 per pound, or roughly 88 cents per troy ounce equivalent when we adjust for comparison. That's a massive price difference. We're talking about silver being 30 times more expensive than copper on a per ounce basis. Suddenly the incentive to find an alternative becomes crystal clear. The technical challenge seemed insurmountable for years. Copper's electrical conductivity is about 6% lower than silver's. In the world of solar efficiency, where every fraction of a percentage point matters, that difference was considered unacceptable. Solar panels already lose significant energy through various conversion inefficiencies. Adding another loss through inferior electrodes seemed like moving backwards. But necessity, as they say, is the mother of invention. Researchers and manufacturers across China, Europe, and other major solar production hubs have spent the last several years working intensively on copper metallization technology. They've developed new electroplating techniques, advanced chemical processes, and innovative barrier layers that prevent copper from degrading or causing problems within the solar cell structure. The breakthrough came gradually, then suddenly. By late 2024 and into 2025, multiple major manufacturers announced successful implementation of copper-based electrode systems in their production lines. These aren't prototype systems or laboratory curiosities anymore. We're talking about commercial-scale production of solar panels using copper instead of silver for the primary electrode material. The efficiency loss? Manufacturers have managed to reduce it to less than 1% in many cases. Some advanced designs claim near parity with silver-based systems. When you can save $20 to $30 per panel by switching to copper while sacrificing less than 1% efficiency, the business case becomes overwhelming. Let's talk numbers that really matter. Current solar panel production requires approximately 20 milligrams of silver per watt of capacity. A typical residential solar panel rated at 400 watts contains about 8 grams of silver. That's roughly $7 to $8 worth of silver at current prices per panel. Multiply that across the millions of panels produced globally, and you see where this is going. Industry projections suggest that by 2026, copper-based electrode systems could capture 20 to 30% of new solar panel production. By 2030, some analysts project that figure could reach 60 to 70% of the market. We're not talking about a minor shift. This is a wholesale transformation of how solar panels are manufactured. The Chinese solar industry, which dominates global production with over 80% market share, is leading this charge. Cost reduction has always been their primary competitive advantage. Chinese manufacturers can produce solar panels cheaper than anyone else on the planet, and eliminating expensive silver from their production process represents another leap forward in that cost curve. Several major Chinese solar companies have already committed to transitioning significant portions of their production capacity to copper-based systems over the next 2 to 3 years. European manufacturers are following suit, albeit more cautiously. They're emphasizing the environmental benefits alongside the cost savings. Copper is more abundant, easier to recycle, and its extraction typically has a lower environmental footprint than silver mining. In markets where green credentials matter to consumers, this messaging resonates. Now let's connect this to the broader silver market dynamics. Silver mining production has been relatively flat over the past decade, hovering around 800 to 850 million ounces annually. Unlike gold, roughly 70% of silver comes as a byproduct of mining other metals like zinc, lead, and copper. This means silver supply isn't particularly responsive to silver prices. You can't just open more silver mines when prices rise. On the demand side, silver has relied on steady growth in industrial applications to offset declining demand from photography and silverware. Solar has been the star performer, growing from almost nothing 20 years ago to that massive 100 million ounce annual demand figure today. Investment demand fluctuates wildly based on monetary conditions and investor sentiment, but industrial demand has been the stable foundation supporting silver prices. Remove or significantly reduce that solar demand pillar, and the entire silver market structure changes. We're potentially looking at a shift from a market that was projected to be in deficit over the coming years to one that could find itself in surplus. Basic economics tells us what happens next. Reduced demand plus stable or growing supply equals lower prices. The silver bulls have built their case partly on projected solar industry growth. The International Energy Agency and various renewable energy organizations have forecast massive expansion in solar capacity over the next decade. Their models suggested silver demand from solar could double or even triple by 2035. That narrative supported higher long-term silver price projections and made silver an attractive investment for those bullish on the energy transition. But those projections assumed continued use of silver in solar panels. They're now being revised downward, in some cases dramatically. If copper substitution progresses as rapidly as current trends suggest, silver demand from solar might actually decline in absolute terms, even as total solar panel production grows exponentially. That's a complete reversal of the expected trajectory. The timing couldn't be worse for silver investors. Global economic uncertainty has already weighed on industrial metals demand. Manufacturing activity in major economies has been sluggish. Electronics demand, another major silver consumer, faces headwinds from slowing smartphone sales and cyclical downturns in various tech sectors. Silver was counting on solar to be its growth engine. That engine is now sputtering. Price action in the silver market has reflected this growing concern. We've seen increased volatility and difficulty breaking through key resistance levels. While gold has managed to hold relatively firm due to its monetary role in central bank buying, silver lacks that support mechanism. It trades more like an industrial commodity, and industrial commodities tend to struggle when a major demand source disappears. The investment implications extend beyond just silver prices. Silver mining companies face a double challenge. Not only might silver prices weaken, but the growth story that justified premium valuations for pure silver miners is now in question. Primary silver miners, those companies that generate most of their revenue from silver rather than as a byproduct, are particularly vulnerable. Their share prices have already shown weakness relative to the broader mining sector as investors digest these developments. There's also a knock-on effect for silver recycling operations. Higher silver prices and growing solar panel deployment had created expectations of a robust recycling stream in future years as older panels reached end of life. Those panels contained valuable silver that could be recovered and reintroduced to the market. But if new panels contain copper instead, that future recycling stream shrinks dramatically. This affects the entire secondary supply chain built around silver recovery. Let's consider the counterarguments, because no market thesis is complete without examining the opposing view. Some industry observers argue that copper substitution will be slower than pessimists fear. They point to technical challenges that remain unsolved, particularly regarding long-term durability and performance in various climate conditions. Silver-based panels have a proven track record of 25 to 30 years of reliable operation. Copper-based systems are newer and haven't been tested through decades of real-world exposure. There are also concerns about copper corrosion and reliability issues that could emerge over time. While initial efficiency might be acceptable, what happens after 10 or 15 years of exposure to humidity, temperature fluctuations, and other environmental stresses? If copper-based panels fail prematurely or degrade faster than silver-based panels, the cost savings evaporate when you factor in replacement expenses. Additionally, the highest efficiency solar panels, those premium products targeting residential and commercial markets where space is limited, may continue using silver. When a customer needs maximum power output from a limited roof area, they'll pay extra for those percentage points of additional efficiency. This could preserve a niche market for silver-based panels even as the mass market shifts to copper. Some manufacturers are also exploring hybrid approaches. These use copper for the bulk of the electrode structure, but retain silver in critical areas where its superior conductivity provides the most benefit. This reduces silver consumption by 50 to 70% rather than eliminating it entirely. If hybrid designs become the dominant technology, silver demand from solar would decline significantly but not disappear. The solar industry's explosive growth trajectory could also provide a buffer. Even if copper captures an increasing market share, the absolute size of the solar panel market is expanding so rapidly that silver demand might not decline in absolute terms. If solar panel production doubles over the next 5 years while copper substitution reaches 50%, silver demand would remain roughly flat rather than falling. That's still a problem for the growth narrative, but it's less catastrophic than an outright demand collapse. Furthermore, silver has other applications that continue to grow. Electric vehicle electronics, 5G infrastructure, and various emerging technologies use silver in ways that don't have obvious substitutes. The total silver demand picture includes these diverse sources, not just solar. Some analysts believe growth in these other areas could partially or fully offset losses from solar substitution. There's also the supply side to consider. While silver production has been flat, some mines are reaching depletion. If production begins to decline even modestly while demand from non-solar sources continues growing, the market could remain relatively balanced despite losing solar demand. But let's be realistic about the most probable scenario. The economic incentives for copper substitution are simply too compelling to ignore. In a competitive global market where cost efficiency determines survival, manufacturers will adopt whatever technology gives them an edge. The Chinese manufacturers who dominate this industry have shown repeatedly that they'll pursue cost reduction aggressively and rapidly. Once a few major players commit to copper-based production, others will be forced to follow or risk being priced out of the market. The transition timeline is the key variable. A gradual shift over 10 to 15 years would allow silver markets to adjust slowly, with prices drifting lower but not collapsing. Supply could adjust through mine closures and reduced byproduct output. Alternative demand sources could develop to partially fill the gap. The market could reach a new equilibrium at somewhat lower price levels without major disruption. But if the transition accelerates, if we see a rapid flip where 50% or more of solar production switches to copper within 3 to 5 years, the adjustment could be much more painful. Silver prices could face sustained downward pressure. Mining operations could face financial stress. Investors who bet on silver's solar-driven demand growth could face significant losses. Current market positioning suggests many investors haven't fully priced in this risk. Silver investment holdings remain elevated by historical standards. Exchange-traded funds backed by physical silver hold substantial inventories. Speculative positioning in futures markets shows a mix of bulls and bears, but overall sentiment hasn't turned decisively negative. This suggests there's room for disappointment if copper substitution proves more impactful than currently expected. The situation also creates interesting relative value dynamics within the metals complex. While silver faces this demand threat, copper itself benefits from the same solar industry growth, plus electrification trends across the broader economy. Electric vehicles, power grid upgrades, and renewable energy infrastructure all require vast amounts of copper. Some analysts argue copper is entering a structural deficit that could support significantly higher prices over the next decade. So, we have a situation where solar industry growth benefits copper while potentially harming silver. The traditional gold-to-silver ratio might also be affected. Historically, silver has tracked gold with higher volatility, serving as a leverage play on precious metal sentiment. But if silver increasingly trades like an industrial metal rather than a monetary metal, that relationship could weaken. Gold might hold up based on central bank demand and monetary concerns, while silver struggles with industrial demand headwinds. For individual investors and traders, this creates both risks and opportunities. Those holding silver bullion or mining stocks as part of a renewable energy thesis need to reassess their positions. The fundamental case has changed materially. That doesn't necessarily mean sell everything immediately, but it does mean adjusting expectations and perhaps reducing exposure. Conversely, traders might find opportunities in volatility as the market digests these developments. We could see periodic rallies based on temporary supply concerns or investment demand spikes, even within a longer-term downtrend. Option strategies that profit from volatility rather than directional moves might be particularly relevant in this environment. The mining sector presents stock-specific opportunities. Companies with diversified metal portfolios that include copper, gold, or other metals alongside silver may weather this transition better than pure silver plays. Investors need to examine individual company portfolios, cost structures, and asset quality rather than treating all silver miners as interchangeable. There are also second-order effects worth monitoring. If silver prices do decline significantly, it could impact production economics for polymetallic mines where silver is an important revenue contributor, even if not the primary product. Lower silver prices might force some marginal operations to close, which could affect supply of the primary metals they produce. These ripple effects across the mining sector could create unexpected winners and losers. The geopolitical dimension adds another layer of complexity. Silver mining production is concentrated in relatively few countries, with Mexico, Peru, and China as top producers. China's dominance in both solar manufacturing and silver production creates interesting dynamics. Will Chinese policy favor their solar manufacturing industry's desire for cheap inputs over their silver mining industry's preference for higher prices? The answer seems obvious, given the relative economic importance of each sector, but state policy can sometimes surprise. Looking at the technical price charts for silver, we see a metal that's been range-bound for extended periods with occasional volatile breakouts that ultimately fade. The price action suggests a market searching for direction, unsure whether inflation concerns and monetary debasement fears or industrial demand headwinds should dominate. The copper substitution story tips the scales toward the bearish scenario, unless offset by some major new source of demand or supply disruption. From a fundamental valuation perspective, silver increasingly looks expensive relative to industrial metals if we're losing a major demand source. The premium silver commands over copper on a conductivity-adjusted basis made sense when solar panels locked in long-term demand. Without that foundation, silver needs to trade more in line with its remaining industrial applications and whatever monetary premium investors assign to it. That suggests lower prices unless the monetary aspect strengthens considerably. The environmental and social governance angle is also worth considering. Some investors view silver as a green metal because of its role in renewable energy. That narrative faces challenges if silver loses its solar application, while copper gains. Copper also has strong ESG credentials as an essential material for decarbonization. Investment flows driven by ESG mandates might shift accordingly, creating another headwind for silver. We should also acknowledge uncertainty around future technological developments. Just as copper is displacing silver now, some other material or technology could emerge that disrupts current assumptions. Advanced materials research continues at a rapid pace. Graphene-based electrodes, organic photovoltaics, or entirely different solar technologies could render this entire discussion obsolete. But we have to make decisions based on visible trends, not hypothetical future breakthroughs. The key takeaway for anyone invested in or considering silver exposure is this: the market structure has fundamentally changed. Silver's growth story relied heavily on solar demand expansion. That pillar is crumbling before our eyes. This doesn't mean silver has no investment case, but that case is weaker than it was and requires different supporting arguments. Investors need to adjust their expectations, portfolio allocations, and risk management accordingly. For the broader commodities market, this serves as a reminder that industrial demand can shift rapidly when economic incentives align. No application is truly permanent or secure. Innovation, cost pressures, and competitive dynamics constantly reshuffle the deck. Investors who assume current trends will continue indefinitely often get caught on the wrong side of structural changes. This brings us to the end of today's deep dive into the copper substitution revolution and its impact on silver markets. The transformation happening in solar panel manufacturing represents one of the most significant demand shifts in the commodities world today, yet many investors remain unaware of its implications. As this story continues to unfold over the coming months and years, we'll see whether silver can find alternative sources of demand growth, or whether prices face sustained pressure from this fundamental change in its largest growth market.
Now, speaking of metals facing critical supply challenges, in our next video, we're going to explore a different commodity crisis that's flying completely under the radar. While everyone's focused on copper, lithium, and rare earths, there's another industrial metal facing severe supply constraints that could send prices soaring over the next few years. This metal is essential for everything from stainless steel to super alloys, and production simply cannot keep up with demand. The supply-demand imbalance is even more extreme than what we've seen in other critical materials, yet mainstream investors are largely ignoring it. If you want to discover which metal I'm talking about and why it could be the best performing commodity of the next decade, make sure you're subscribed to this channel and hit that notification bell so you don't miss it. That video will be coming very soon, and trust me, you won't want to miss this opportunity before the rest of the
market catches on. Thanks for watching, and I'll see you in the next one.